Okay, so welcome back to the desk. We're going to move on now to our next economic driver, which is employment. Now, obviously, jobs and jobs data is important to the financial markets because when we're even looking in the way we do things, we're trying to gauge inflation, deflation. And obviously, if more people are in work in both the private and government sector, this is leading on to a situation where it becomes more inflationary in an economy because there's more salaries being paid and there's more money being spent on consumption. And also on the other side, there's more taxes collected by government, and government collecting more taxes can therefore spend more from the public coffers. So there's more money being injected into the system, both in the private and the government sector. So that leads us to a situation to gauge that we're entering a slightly more inflationary period. And the opposite can be said and is true if there's less jobs in both the private and the government sector. So overall, jobs are important, but there's a lot of emphasis placed on particular numbers in the financial markets, especially by retail traders. And we're going to be looking at the NFP number, the non-farm payrolls number. And there's a lot of emphasis placed on this by retail. And this is done for several reasons. We're going to find out those reasons when we go over to the computer screen. But the conclusion that we're going to get to here, that you're going to see, is that we need to kind of reprogram the way we do things, because the NFP number, although it's important, it's not just a situation in the financial markets as a trader where you base all of your decisions on one or two economic numbers. As we're building out a systematic process here, you're beginning to appreciate that on the professional side, the way things are done is building an overall systematic process, and each economic number is simply just one driver within this overall process of many, many drivers. But also the way we analyze these numbers is actually quite different to the way the market analyzes them, or in particular the retail market. So for us, employment is just one driver that's part of an overall process of many, many drivers, and we assess the number historically to see what is normal and what is abnormal, and we use total objectivity, and we also use base metrics. So when we go over to the computer screen, you're going to see that there's different ways in which the professional side analyze NFP versus the retail side, and also the way it's calculated and the conclusions that you get to. So let's go over to the computer screen and I'll see you on the other side. Okay, so we're going to start looking at US jobs data now. So we're going to start looking at the Employment Situation Report, or the ESR. And the Employment Situation Report has various numbers that can give us clues as to whether the economic conditions predicted by our leading indicators 6 to 12 months previously are starting to actually show up or give us evidence of the current economic conditions. And the ESR is made up of the following four main numbers. So the Employment Situation Report includes the unemployment rate, includes total non-farm payrolls, includes private sector employment, and includes government sector employment. Now, the number we're going to focus on is the NFP number, the non-farm payrolls number, because that tells us how many jobs were added in the US economy, excluding some of the following areas. So general government employees, private household employees, employees of non-profit organizations that provide assistance to individuals, and farm employees, which are seasonal. So this is where the number gets its name from, total non-farm payrolls, because we're basically stripping out seasonal farm employees and also other types of employees that can be sporadic or basically move the data. So it's kind of like our inflation data. We're looking for a stable and core number that gives us a good reading in the US economy on employment. The makeup of the non-farm payrolls number basically tells us how many jobs were added in the US economy in the previous month. So not this month or in the future month or several months behind, several months in the future, but the month that we're currently in, the number tells us what happened to jobs, how many jobs were added to the US economy in the previous month. And the number can be positive or negative, so jobs added or jobs taken away from the US economy. And it's basically made up of jobs that have been added in the last month in the private and government sectors. The unemployment rate is actually calculated in a different way, so calculated separately by the CPS, the Current Population Survey. And that's because the government can't accurately calculate the true unemployment rate by simply counting up the number of people that have claimed for unemployment insurance or knocking on every door in the United States. So the non-farm payroll number, if it tells us what's happened in the previous month, it's basically an economic number that is considered to be a coincident indicator. And if you recall, when we look at our flowchart of predicting and reactionary variables, the coincident numbers sit in the middle of our overall roadmap of economic variables. So we had our leading indicators on the left-hand side. We had our monetary and fiscal levers on the right-hand side that are reactionary, and we have our coincident indicators in the middle. And unemployment is very similar to inflation in this way, because central authorities on the right-hand side are committed to making the variables, both inflation and employment, stable. And when it comes to jobs, there is obviously also a political element to this as well. So it's not just about the central bank, it's also about government reacting to this as a driver. But on the left-hand side, we also have our leading indicators, and our leading indicators with 80% accuracy correlation to GDP are predicting future inflation and future job growth, or no growth, as negative growth, as the case may be. So it's very important to understand where the NFP number sits in the overall picture of macroeconomic variables. It's a coincident indicator and therefore lags leading indicators, and it's also a variable that is affected by the reactionary movements of central authorities coming in from the right-hand side. So we need to bear this in mind and bear in mind where this sits in the overall process. And the data, so the data that you need to analyze the non-farm payrolls number is available in this link here. So you can go to this link. We'll be going to it in a moment when we go over to our spreadsheet. But why is the NFP therefore important to us if it's a coincident indicator? Well, as already outlined, it's important because it tells us whether economic conditions predicted by the leading indicators 6 to 12 months previously are starting to show up in the economy. However, it's also important because it's one of the most watched and talked about numbers in the United States by the public. so consumers themselves, and the government, politicians, and also traders, and much more so retail traders, which we'll come on to in a second. For consumers, it can actually affect consumer sentiment as well. If they're constantly hearing good or bad employment data in the media, and for government or politicians, it can also affect their policy. So although the jobs data and employment is sitting in the middle as a coincidence indicator, by definition, the NFP can also affect causality slightly in the other way. So consumer sentiment being our leading indicator, or one of our leading indicators, if you imagine consumers, if they constantly hear bad employment data and that many people in the United States are losing their jobs every month, month on month, then it can cause an effect where consumers may start to tighten their belts. And also in the opposite situation, if they constantly hear good news about jobs month on month on month, this can actually increase consumer sentiment, and consumers start to feel more confident about their future. So in the vast majority of cases, consumer sentiment as a leading indicator does drive coincident indicators like employment, because as they're spending, this creates growth and inflation, and more employment occurs. But in the minority of cases, you do get a feedback loop from the data itself, and this can be bullish or bearish for consumer sentiment itself moving forward. So we just have to bear in mind where the NFP numbers sit in the overall process and what effect they can have on the leading indicators, but also to the right-hand side of our overall roadmap of economic variables, on the right-hand side for government, because at the end of the day, jobs, it's not just about economics, it's also about politics, and government through fiscal policy can be affected too. Now, we also mentioned traders and retail traders in particular. So day traders, retail traders tend to focus on the NFP number as some sort of panacea number or their main economic guide as to what is happening in the economy. Well, from a professional trader's perspective, this is actually just totally wrong, because first of all, it's a coincidence indicator and it lags leading indicators. Secondly, the market receives weekly jobless claims numbers. So by the time the NFP number is reported, there shouldn't be any surprises, and more often than not, there actually isn't. So why is this important to us as professional traders? Well, it's one of our economic variables that is a driver or input to our overall systematic process. And it's useful for building out our endogenous bias. So building our endogenous currency bias as part of an overall check consisting of many numbers that we're scoring for, not as a standalone reason to decide whether to buy or sell euro dollar. That's basically a lazy or lagging, suboptimal dumb money approach. And it's very typical of retail traders to focus only on one number and react to that number. So initiate positions on a number that is actually backwards looking. So as professional traders, the NFP numbers are just one driver as part of an overall systematic process. We're using the ESR report as part of our wider analysis to decide on the current and future prospects of the US economy, and we're using it as a wider analysis to gauge inflationary or deflationary conditions and to help us build out this overall endogenous bias. And as just mentioned, one of the most amateur mistakes made by retail traders is to use coincidence indicators to initiate positions. So let's have a look at an example here. If it's forecast by economists that the NFP number this month, so the number that's reported this month, is giving you the data for last month. Let's say that number is set to come out at 150,000 jobs added in the US economy last month, and the number beats and is reported at 200,000 jobs added. Well, that doesn't mean you should be looking to buy or sell euro dollar based on that data, because firstly, it's backwards looking. It's telling you what's happened last month. And secondly, we've already got, up to this point, the weekly jobless claims numbers, which should be giving us a very good idea as to the level of jobs expected. So this is there's kind of a slight double entendre here, because we're about to offend economists who are supposed to be on the professional side of the market. Professional traders themselves will have been told for months that the employment situation is set to improve in the employment components of the ISM and the NMI, and from the previous month of lowering weekly jobless claims. So you've got to ask yourself the obvious question here, which is, well, why aren't the numbers that are supposed to be the expected numbers moving to take this into consideration? Well, the vast majority of times the NFP number is going to be priced into the market. And when we say the market, we mean professional traders, as in the market will have already forecasted this 200,000, but economists just simply haven't updated their estimates or not done it properly. And what we also have to consider is that the 200,000 number itself is an absolute number. It's not a base number. So it's not a percentage comparison, as we've been looking at previously in the foundation section of the video series, and also in the other, when we're analyzing other macroeconomic variables. So a number like the NFP just beating can literally be a situation where economists, or just a few of them, haven't actually gone and updated their numbers properly. So you've got to be very, very careful with this number, because it really obviously isn't a panacea. First of all, it's reactionary. So it's a coincidence indicator that is backwards looking, and it's telling you what happened last month in the economy. The data that we already have from weekly jobless claims and from the leading indicators much before that will be giving us a very, very good idea and gauge as to what the NFP number will be. And then on top of that, it's not a base comparison number. It's an absolute number. So it's not a percentage comparison. So we can't really draw conclusions to a day trading strategy as to whether the NFP number is slightly better or slightly worse than expected. Now, you'll often see a lot of stuff in the media focusing on the NFP numbers, and that's media driven for ratings, but also it's driven by those with conflict of interest. It's obviously a fairly straightforward one-dimensional approach and number to understand, you know, how many jobs were added last month, and the number comes out, and if it beats expectations, you should be doing this. If it misses expectations, you should be doing this. Well, that's something that's perpetuated by most people with conflict of interest, so brokers and educators. You'll often see a lot of volatility around NFP numbers in financial assets, but it generally only lasts 10 to 60 minutes. And everybody's trying to guess which way to go. In professional trader circles, you'll often hear lines like, "Here come the NFP monkeys." That's meaning pros are prepared to take the other side of whatever they do, so whatever retail traders do in the short term, because the market knows, the market as in professional traders know, that a beat in the numbers is actually fully expected, and that the consensus numbers for the NFP number this month just haven't shifted to where the reality is. And when we say priced in, what we mean is that months before, the leading indicators, so the ISM and NMI, employment components, are actually telling professional traders that in a few months' time, there's going to be more jobs coming online. And these jobs will be counted in the NFP number, which is coincident, telling you what's happening now or the month before. So the professional traders know this, and the financial assets that are moving on the NFP number and providing them with volatility, those financial assets are either bought or sold months before the NFP number comes out, or in the previous month with the lowering weekly jobless claims numbers. And what's happening if you're a retail trader and you see the NFP number beat or miss expectations by a small amount, and you're trading these financial assets, what you're actually doing is you're doing the opposite of what the professional trader is doing, because the professional trader is now actually probably trading out, or trading out of a large part of their position and using the liquidity of the NFP monkeys to get out of that position. So you can see now how the causality works. And when we think of this in the bigger picture, you can start to appreciate why we have leading indicators on the left-hand side, governments and central banks with fiscal and monetary policy on the right-hand side, and those guys are respectively leading indicators predicting and central authorities reacting. And we have the coincident indicators in the middle, and employment is a coincident indicator as reported by the data and by the definition of the data. And the employment data is lagging the leading indicators, but it's also affected by central authorities and their policy. And that's due to creating economic growth from central banks, and also from governments, because they're committed politically to job creation. So when you think of the NFP, that's how you've got to think of it in the back of your mind. You've got to see the NFP for what it is in the bigger picture, and for what it is by definition. And it's still useful to us, as we've already mentioned, because it does give us a gauge on the future prospects of the US economy, and gives us a gauge on current and future inflationary or deflationary conditions. But we have to define it properly, and we have to engage with it in a systematic process and see it as one driver of an overall systematic process. And in our overall systematic process, it's one driver in the endogenous analysis, hopefully giving us a bias as to whether to be short or long the currency. So whether to be short or long bias. So which way are we leaning towards? Do we see inflation? Do we see deflation overall? And the NFP number is just one number that we look at. So you can start to understand and appreciate now how the differences between retail traders and professional traders are when it comes to analyzing economic data and how it's interpreted and treated. Now, how do we start to look at this data? Well, the first thing you're going to see when you download the numbers, you're going to see the nominal numbers, and these are really not very useful to us because we're not really learning anything. As you can see here, if we go back to the beginning of the data, 1939, and you can see the amount of jobs in the US economy, the amount of jobs added to the US economy, what you're seeing is actually a function as much of population as of anything else. So obviously the population in 1939 in the United States was much smaller. So an increase of 30,000 jobs month on month could have been a large part of the population at that point in time. Whereas now the population is much higher, and we have an absolute number of 140,000 jobs added in the month. And that percentage, if we worked it out as a percentage, could actually be much lower than this number. So what we're looking at here is the history of monthly ads on an absolute basis. So these are nominal numbers, and they can be as much a function as population as of anything else. So we've got to be careful how we analyze these numbers and do it properly. What we have here is the absolute number on the left-hand side. So the monthly absolute change in employment in non-farm payrolls on the left-hand side, and that scale goes from minus 1 million up to 1 million. And on the right-hand side, we have real GDP growth. And this is quarterly real GDP growth annualized. On the chart, we have in green the non-farm payrolls monthly absolute change. And in red, we have the GDP, real GDP percentage change. And you can see, obviously, there is a decent correlation between the two. But this is actually not a great way to look at it. And this is something we just picked up on, which is one of the problems with the NFP number is that everybody focuses on the nominal change in the last month. So for example, the US adding 285,000 jobs in the last month. Well, that's great, but it can mean nothing because it's only useful to us in the context of history as a percentage, as a base number, as we've learnt in the foundation section of the video series, and also further areas when we're looking at macroeconomic numbers. As traders, we need a base number, and this is to enable us to make historical comparisons on a level playing field. And if we can make historical comparisons on a level playing field, we can actually make informed analysis and judgments and decisions from the numbers. Because what we're trying to do with all our macro numbers is to actually figure out what is normal and what is abnormal. So it's not going to work for us just by looking at an absolute number, even though we've got a decent correlation here when we look through business cycles and the history of those business cycles. So GDP as the business cycle relative to jobs growth in a nominal sense. What we've got to do is work everything out in percentage terms and get the base metric, get the level playing field, so we can make an informed analysis and we can make an informed decisions and judgments. So how does it look pictorially when we go through this properly? So here we've got on our chart, and by the way, these are all available in the spreadsheet. We'll go over to the spreadsheet in a second. When we look at this pictorially on the chart here, we have the monthly percentage change in non-farm payrolls on our scale here on the left-hand side. And this is going from minus 1.5% change on the month to positive 1.5% change on the month. And on the right-hand side, we have real GDP. So we have a scale here of quarterly annualized real GDP of minus 15 all the way up to plus 15%. And you can see here that when we look at real GDP against the monthly percentage change in NFP numbers, we actually have a much better correlation when compared to the absolute numbers on the left-hand side. And what we're also doing here is looking to compare these numbers, like in previous analysis, to GDP to discover what is normal and what is abnormal. So what lies within one standard deviation and what lies outside the normal bands, and we score accordingly. So we do our statistical distribution, as we do with many of our numbers. We figure out what is normal within the historical data and what is abnormal. So what lies within one standard deviation, what lies outside one standard deviation. And we look at our current numbers and we compare them and we scorecard across by looking historically at the monthly percentage changes and what levels those monthly percentage changes are associated with levels of GDP. So, for example, here, when we look at our long-term number, which is generally trending lower in terms of percentage changes, we have roughly a 1% GDP growth rate associated with a 0.1% positive change in monthly employment and a 2% real GDP annualized growth rate is associated with around 0.2% positive monthly change in NFP. And that's how we build out our scorecards in a very similar process to the way we've done it before with our other economic indicators. Now, if we zoom in here, we can zoom in to a more recent period to understand the data. And we can start to realize a few things when we look at a more recent time period. So although we've taken the data going back all the way to 1954, we've zoomed in here for the period 92 to present day. And you can see that generally speaking, when we look at the positive areas, there's a very high correlation between the monthly percentage changes, the positive monthly percentage changes in non-farm payrolls and positive levels of GDP. But what we also realize is that it's associated with certain levels, on average, certain levels of real GDP. So we can see here again that when we zoom in, around 0.2, 0.3 is associated with 2 to 3% GDP, real GDP growth annualized. In the negatives, we can also see that negatives are generally always associated with real negative GDP. And one case here, which isn't a negative, but we get real negative GDP following a big fall in the non-farm payroll monthly number. So we can actually go over to the spreadsheet and just quickly have a look at these numbers. And if we go in to the NFP tab first, you'll see we've worked out the statistical distribution here. But if you go into the sources area, you'll be able to get the link here. And if you click on the link, this is going to take you to the US Department of Labor, Bureau of Labor Stats. And you can see here, we've got all the data and downloadable from a spreadsheet. So all you have to do is hit that, and that will take you over to your spreadsheet with all the data. And then, as we've done with previous numbers, we take the numbers and we start to work out our distribution. So we have our dates, and they're going up in increments of a month. We have our NFP value. We have our absolute monthly change. And we have our percentage change month on month. And our percentage change month on month is using the B column, the NFP value, to work out the percentage change month on month, all the way down. And if you scroll all the way down, you're going to see all the way to the latest data right at the bottom of the sheet. So we have our usual stats, we have our intervals, we have the frequencies of these intervals, we have our labels here, which is feeding our histogram, we have our probabilities of the frequencies occurring, and we have our cumulative probabilities. We also have our descriptive statistics for the NFP. We have our standard deviation here. Up here we have all of our averages. So first of all, we have our total mean for all of the data. We have our count. We have the average cases in both the positive and the negative readings. And to the right-hand side, as always, we analyze our distribution of the statistics relative to a normal distribution. We have our scorecard here, which we'll be looking at in a moment. But we also have our charts here, which are being fed by the data on the left-hand side. With the charts, please go into this in your own time. Have a look at the data and see where it's all feeding from. And all you have to do every month to update is to basically put the latest statistic here and change the charts by selecting data, and you just edit and you update the column and the row. So here the row is 923. You just change that to a 4, and that will bring you a chart that's updated, and it will just update automatically for you on your screen. So all of these stats, this should be becoming very familiar to you now. So we're not going to waste too much time going through the whole process again. Let's go back to the presentation and we'll look at these numbers and see what we learn. So before we start looking at these stats, once again, we've provided you with the statistical distribution of the NFP monthly returns. However, you should try for yourself doing a statistical distribution of the initial and continuing claims, because claims data leads NFP data and is provided weekly, whereas the NFP data is only provided monthly. And all the numbers are available in the download section here. Again, we go back to this principle of being the self-starter and having the self-starter mentality. You really do need to learn how to do all this stuff yourself. And throughout our education, we're sticking to the principle of not spoon-feeding you. So again, we're showing you the process. We've been through it. We've shown you the examples. This is something you should go off now and do yourself as homework. It'll be good practice for you. And this type of practice will help you to continue to stay on top of the data yourself forever, and only rely on yourself and not rely on other people to spoon feed you the analysis. Because what we're trying to be here is obviously consistently profitable traders, and consistently profitable traders rely only on themselves for information and to generate ideas for themselves. Now, the data that's also included is the unemployment rate, which is in the download section as well. This is part of the overall ESR monthly release and is basically the inverse of the NFP. So unemployment being the inverse of employment. It's calculated from a different source, but that's how you should see it. And what you can do to practice, you can create a distribution with all these numbers as well. So practice it and compare them. And as we pointed out when we were inside the spreadsheet, with the stats provided, all you have to do to update all of the spreadsheets is to just input the latest number at the bottom of the range, and amend the descriptive stats and formulas in each cell. And that's going to provide you with a shortcut. And the shortcut can be applied to everything else as well that we've looked at, where we've calculated a statistical distribution. Now, staying on top of these numbers isn't at all easy. No one said it ever was. But you should be starting to realize now the real reasons underpinning why 90% of retail traders or 90% of retail currency traders lose money, because really it's about not seeking out a proper education and not doing your homework. And whether that's through laziness or not having the right amount of time to do so. So from a trading education perspective, looking at the NFP number as some sort of panacea number that's going to tell you everything you need to do in trading for the next month. It's not like that at all. The NFP number is obviously backwards looking, it's coincident. It's not as important as our leading indicators, but in a professional, systematic process, it does give us a gauge on inflation and deflation and is one driver that we analyze. In terms of homework, either not having enough time to do the work properly or not doing it through laziness. And if you look at your own situation, if you have 8 to 12 hours a week, you should be able to stay on top of all this data. And if you practice the processes, in the first couple of months, the processes will be alien to you and will be fairly difficult to complete on a regular basis. But once you've practiced several times, the numbers should be fairly easy to keep on top of, as long as you keep a good diary, download the data, upload the data to your spreadsheets, amend your data and charts, and you should be able to do it in a very quick amount of time once you've got used to the processes. So what we're providing here is the process for you and the shortcut to do it. And obviously this process is part of an overall systematic framework which you apply overall to each country and each currency. So staying on top of it's not easy, but you should be able to do this once you get a handle on the process and practice it. Now let's have a look at the data. What we actually found from the non-farm payrolls data is quite interesting. We look at it in the same way as we have in previous numbers, where we take a rolling 12-month percentage change. So we take the current month and the previous 11 months, and we take the average percentage change. And we compare that to our historical data as a statistical distribution, and we build our scorecard and we generate a score for inflation or deflation in current and future conditions as driven by the NFP. And currently, the NFP scorecard gives us a 0.2% number. So the average of the last 12 months, a 0.2% increase in jobs in the United States. So the average month for the last 12 months. And this is basically equivalent to a 2% real GDP growth number. So in terms of gauging inflation, deflation, and growth, what we're concluding here is that it's fairly normal because it's within one standard deviation. One standard deviation of our data is equal to around 0.4%. We also have in the previous month a 0.35% reading. So we're looking here on the scorecard at around this level. So depending on how conservative, how aggressive you want to be, we're going to be scoring around a 5. Because at the end of the day, 0.35% is still within one standard deviation. Therefore, it's within the bounds of historical normality.
So we have a short currency bias from this with a score of around 5, and that provides us with a medium conviction to be looking at shorting the US dollar. And again, this is an endogenous analysis. We're not looking at this relative to any other country. We're just looking at it in absolute terms. So whether the currency is in absolute terms losing value or gaining in value. And here, one of our drivers, the NFP, has told us that jobs growth over the last 12 months is fairly stable. We're getting mild or normal, slightly inflationary conditions. We've had a little blip here, which is touching almost the bounds of normality. However, it's within one standard deviation and within normality. So we have a short currency bias with a medium conviction, and this gets plugged into our overall endogenous analysis and our overall general endogenous scorecard as one driver, not a panacea number. So that pretty much covers NFP. Let's go back to the trading desk for a quick recap.
Okay, so welcome back to the desk. There's a lot to take in there with employment, because we weren't just analysing it and creating a statistical distribution and getting to results. We were also critiquing how retail traders actually view this number. But let's go right back to the beginning. We looked at base metrics, and we realised that there was a major correlation between the monthly percentage changes of the NFP and real GDP that's slightly lagging it. And when we compared this to absolute numbers, we realised that there was a correlation with absolute numbers to GDP, but the correlation is a bit looser. It's actually a lot looser. So lower correlation between absolute and real GDP. So this means that if you're doing it as a retail trader and just looking only at the NFP and maybe one other number as your economic guide to decide whether to buy and sell currencies, it just means that basically if you're looking at the absolute numbers and doing it in that way, that you can be wrong more times, because there's a lower correlation with the absolute numbers relative to percentage monthly changes. And also, it's a slightly lagging number. It's a coincident indicator that's lagging the actual leading indicators. So it just means that when you look monthly at the numbers and you look at the expected numbers and decide, well, if it beats, I'm going to buy, if it misses, I'm going to sell, it just means that when you're looking at that, when you're right, you're more lucky than you are actually being right because you're smart. And when you're wrong, it's actually quite normal to be wrong, because first of all, you're looking at absolute numbers, and secondly, it's a lagging indicator as a coincidence indicator because it lags the leading indicators, and weekly jobless claims have been going down into that number or going up into that number. And it can just be a question of estimates from economists not being updated. The real market, the professional traders, have been watching it all the way into the number and know that it's a low consensus, or they know it's a high consensus. So if you're basing all your decisions on that, you're either going to be right because you're lucky, or you're going to be wrong, and that's pretty normal to be wrong, because retail traders get it wrong all the time when trading the NFP number, or in more cases they get it wrong than right. So first of all, it's base metrics, and secondly, the definition is that it's coincident. And these are the results that you have to understand as a retail trader, that if you pin all your hopes on an NFP number for giving you the guide as to buy and sell currency pairs, you're going to be wrong more often than right, and if you're right, you're probably just lucky. So you need to be very, very careful. We then went into our analysis properly. We created our statistical distribution with our base metrics, and we did this with objectivity, knowing that these numbers are lagging. And we started to realize that, again, in the majority of cases, we do get employment adds in terms of positive percentage numbers in the vast majority of cases. So the split, if you look in the spreadsheet on the numbers, is actually 75% of times, so 75% of months in history, we get a positive number, and 25% of times we get a negative percentage change month on month. And this is how we start to build out our scorecards. So in the same way as we've done with previous numbers, we analyze the statistical distribution to find out what is normal and abnormal and build our scorecards using that as our driver and understanding of how things work. And you'll realize again the makeup of the scorecard is quite similar to previous scorecards, where we have the inflationary zone for ads and ads outside of the normal band. So within the normal monthly percentage changes, we have an inflationary prediction, short bias, and the score, which is in the normal bands, is given as fairly low, and it gets higher on the abnormal moves and then tails off at the end, because on the very extreme moves we're predicting that it can't get any better and that there may even be some central authority action to actually deflate that number. Then we have the deflationary zone, which in this case we score quite highly on, simply because it only happens in 25% of times where we get a zero or a negative number. But on the extreme moves we're predicting inflation, and with jobs we give it a high score on predicting inflation because we know it's political and we know that the authorities will react at all costs. So this actually brings us on nicely to our next video. We're going on now to look at central authorities and how we actually analyse all the data from central banks and governments. So let's go over to the next video and I'll see you on the other side.